Investors and managers use financial statements to understand not what has happened in the past, although that's what they really record, but to get an idea of what will happen in the future or to what to expect to happen in the future. Now, there's this premise, this idea that what has happened in the past will continue on in the future. This past performance is an indicator of future performance is commonly stated on investment advice that it may not necessarily be true, but we really don't have any other information available to us. We don't have a crystal ball. We can't see into the future. So we make this assumption that past performance is just a continuation on into the future. So we use analysis of financial reports coupled with a lot of other factors that may affect or change what has happened in the past into the future. Some of these might be management changes, business expansions, government contracts, changes in the economy, especially economic conditions can have a significant impact on what happens in the future, and they can provide us with a more accurate assessment of a firm's current financial health and the likely future prospects. Example of this is IBM. IBM started International Business Machines as a typewriter company. Now, obviously, they don't produce typewriters anymore, but if you started to see the future and the changes in technology, you would have written off IBM. However, IBM was able to change with the times and has become a very successful and now a technology and consulting company. Public companies have to produce and are required by the Securities and Exchange Commission, or the SEC, have to produce a series of statements, and these come out in what are called annual reports. Annual reports, as the name suggests, are issued annually. They're issued publicly if they're publicly traded companies. If they're private, then they will be issued privately to the firm's shareholders. They contain several parts that are required. They always contain parts that aren't required. They start with a narrative describing the results of the firm's operations during the previous year. This is typically written by some managing executive of the company. And it's usually a quite rosy picture. Even if the past has been very poor, it will be quite optimistic and typically has to be taken with a grain of salt. Financial statements are also included, starting with the income statement for that accounting period or that year. A balance sheet is required, and a year-end balance sheet. Since 1987, they've also required a statement of cash flows. We won't be using the company's provided statement of cash flows in our assignments and in this class. We'll be creating our own, actually using the income statement and the balance sheet to create the statement of cash flows. And then the final statement that is required is a statement of retained earnings. And this is basically telling the shareholders of the company that this is what we made as a net income and this is where it went. There are two types of information that you can derive from these annual reports. The narrative obviously is typically mostly qualitative, and the quantitative portion is found in those financial statements. Quarterly financial statements also are produced, and they will typically contain the same info, or the same type of info, but they will be on a quarterly basis. Let's start with the balance sheet, and this is a review. I hope this isn't new to you. A balance sheet reports the status of a firm's investments in the current and long-term assets. It reports the status of the firm's financial obligations in the terms of liabilities and equity. It's called a balance sheet because the assets, or the left-hand side of the balance sheet, must equal the liabilities and stockholders' equity, or the right-hand side of the balance sheet. The balance sheet is sometimes called a snapshot. It provides a snapshot in time of the assets of the company relative to the contingent liabilities and the owner's equity. If you were to do a personal balance sheet, you would count up the value of all the assets that you own and that would be placed on the left-hand side. And then on the right-hand side, you would accumulate all the debts that you owe. The difference between your assets and your debts is what's called your personal worth or your financial net worth. That's the same thing as the stockholders' equity on a firm's balance sheet. The balance sheet has a claim priority, and the claim priority is found on the right-hand side and typically goes from the top to the bottom. In the case of bankruptcy, holders of a firm's debt have a priority claim over the firm's assets than the stockholders. And that's really all bankruptcy is. It's just an exchange or a change of ownership from stockholders to bondholders or debt holders. Retained earnings are the portion of the firm's earnings that have been saved rather than paid out as dividends. And preferred and common stock are differentiated in the stockholders' equity portion. Stock is a partial ownership in a firm. It's like debt since it promises, preferred stock, however, is like debt because it promises a fixed dividend. It has a higher claim than common stock. However, most firms, especially mature firms, don't issue preferred stock. And when they do, it's typically in small quantities to select individuals. As companies grow, they'll issue debt first, then a small selection of preferred stock to the initial investors. And then finally, as it matures, they'll issue common stock, typically as an initial public offering or an IPO. And then finally, they could do what's called a seasoned equity offering or secondary equity offerings. Some other terms that you need to be familiar with on the balance sheet are depreciation. Depreciation is an accounting way to amortize fixed assets and the economic life of fixed assets over an accounting period. Depreciation is important because it represents a non-cash expense, and we need to treat it such that it will be added back when we do our statement of cash flows. Net working capital, by definition, is the current assets minus the current liability. Now, you've been taught this in an accounting class, but I think there's a more important concept that you need to recognize here. Net working capital is sometimes called the grease of the company. It keeps the company wheels and the company engine going. You can think of net working capital like cash in a cash register. When you start up a little store, maybe you were starting a lemonade store as you were a child, you always needed some cash in order to produce change. But at the end of the day, when you're counting up your profits, that cash could be removed. And that's kind of what net working capital is like. It's cash that's needed to initially start the company. It stays within the company, but it's not actually used or physically used up while it's there. And if the company were to be closed down, the net working capital could be taken out. Next, the income statement, sometimes called the profit or loss statement or the P&L. It summarizes the firm's revenue or expenses over an accounting period. Now, this is an important differentiation from the balance sheet. The net income is the bottom line, as we discussed in the last segment. It's often referred to as the earnings available to common shareholders or stockholders. And we say that it's available because it might not necessarily be paid out. It may be retained within the company for further investment, but it is owned by the equity holders of the company. EBITDA, or EBIT, is the operating earnings. It is the earnings from day-to-day operations before interest, taxes, depreciation, and amortization. We'll be using EBITDA, and it will be used and stated as that, but you know that it's about halfway down on the income statement and summarizes the earnings from day-to-day operations. The final statement that we'll be discussing is a statement of cash flows. It's a statement that reports the impact of the firm's operating, investing, and financing activities on the cash flows over an accounting period. Another way of saying that, it tells you where the cash is coming from, and it tells you where the cash is going. And every dollar that comes in should have a source and then a use. It answers such questions as, is the firm generating enough cash to purchase additional assets required for its growth? Is the firm generating enough cash to be used to repay debt or research new projects? Is the firm solvent? Solvent's another way of asking, can the firm pay its debts, or at least its current debts, as they become due? And finally, is the firm generating sufficient cash to remain solvent in the future? Operating activities are those activities that have to do with the day-to-day operations of the company. Payroll, fixed and variable expenses, current portion of short-term debt, and any of these other changes in net working capital. Depreciation must be added back in a statement of cash flows because depreciation represents a non-cash expense. Investing activities are the purchase or sale of fixed assets. So it's like you're investing in the future. Fixed assets are any assets that have an economic life longer than 1 year. And finally, financing activities are the sources of the funding for the operations and the investing activities of the firm. Hopefully, healthy firms are generating cash from operations, using cash from investing, and then they might be making up some deficit from financing activities, such as issuing debt and equity, paying out stock dividends, or purchasing short-term or other securities.